we were already going to discuss today the idea of unlimited depositors insurance offered from the FDIC. I was going to take the opposite side of this argument. I was going to battle you on this and say, there's no way this is actually a thing that anyone can do. Lo and behold, here we are. All of Silicon Valley Bank's and Signature Bank's depositors have been fully insured. Even if it's billions of dollars, they're all good. Can we talk about that? What the hell happened this past
Yeah,
week?
look, I've been working on it for months, and they just tweeted it out. I don't know what to say. It's really, really meant there's not much work left for us to do. No, I mean, it is a kind of incredible moment. I think there's a couple of different things. I was talking to my colleague Nathan Tankus about this. So many of these economic crises happen in a very kind of large, multi-industry, multi-sectoral way. You're talking about a lot of pain for average people. You're talking about mortgages. You're talking about sort of broad-based economic decline. So often the banking regulatory part of the story, it's still there. It's still an important part, but it often kind of comes limping after the protecting the people and, what went wrong overall, where was this sort of fraud or whatever else was going on. But this is such a kind of surgical problem. It's limited to a number of banks. They've got a very particular kind of depositor base. There was a very particular kind of problem with government assets and the regulatory treatment of long-term bonds. And the response was also surgically targeted. So what we're seeing now is this kind of very short, sharp moment where the ideological and regulatory implications for banking in general, I think, are kind of at the forefront of everyone's mind, and there's no other distractions. There's not a kind of 4-month period for the people to get in and out of the conversational flow. By the time people got into it, by the time even the initial narrative started solidifying, it was over. It's happened. And so I think this is a very rare moment where all eyes are on the sort of same very narrow set of banking regulatory questions at the same time.
Can you talk to us a little bit about what a system with unlimited deposit insurance would look like and how that would contrast with our current system, which ostensibly has the $250,000 cap per account?
Yeah, and I mean, I think the first thing is sort of the difference between implicit and explicit guarantees, right? I would say for a long time we've had basically implicit unlimited deposit insurance. Certainly, you look at the vast majority of bank failures, they get put into receivership, their depositors get sold to another bank. Very rarely do you see depositors actually lose any money, and certainly with the big banks, the sort of recognition that they're too big to fail, that if one of the top 4 banks kind of collapse, that the government would probably want to step in long before you got to the point of distinguishing between uninsured and insured depositors. So I think that's the first thing is we've had this for a long time, we just haven't made it explicit, and there's 2 things about that. One is obviously the politics of it, the moral hazard of it. When we keep not acknowledging what we're doing, we don't actually work out how to regulate things properly on the upswing when things are going well, and we don't sort of think about the broader systemic implications. So if we are going to guarantee all deposits, then what is the asset, activity that we are actually implicitly saying is allowed to happen that we will backstop in a crisis moment, therefore taking out any kind of market discipline, market risk out of it. And I think the other part is a legal aspect, which is it's one thing to say, oh yeah, I know I'm going to get bailed out. It's another thing to say 9 times out of 10 we get bailed out. But if you're a money manager with fiduciary responsibilities, right? If you're a bank with fiduciary responsibilities, you can't rely on that as an explanation for why you're putting your funds in an unsafe instrument. Unless you're Circle and you just lie about it on your website and say, oh, it's all backed by cash, and you just sort of quite conveniently and intentionally elide the difference between insured and uninsured deposits for your customers and your marketing materials. Unless you're doing that, then you have to find something else. And so it's kind of funny, someone was saying, where's Zoltan Pozar in this crisis? Because in 2011, when he was first writing about shadow banking, one of the articles that really sort of struck me was one called Can Shadow Banking Be Addressed Without the Balance Sheet of the Sovereign? And his basic point was, this is in part, at least, a safe asset shortage issue. We have a lot of actors that would love to park their money in a safe government account, but because of deposit insurance caps can't. And so they're going into treasuries, and then treasuries have a limited amount. And, because of that mismatch, there's pressure to create, safe asset-like instruments that give the appearance of being safe. And he identified that as a big driver of sort of shadow banking and shadow money in general. But we're also seeing now that this is also a function of the way that we treated bonds. We had this system where these banks were expected to hold on to high-quality liquid assets, and we could value those bonds at hold-to-maturity prices rather than mark-to-market prices. which was fine as long as you didn't actually need the liquidity, right? As long as you didn't actually need to sell those bonds at any point. And I think what we're seeing now is a recognition that even though they are safe in the credit risk sense, they're not safe in interest rate and duration risk sense. But the central bank is basically saying we don't want that to be a problem anymore. We're going to take that off the balance sheet. We're going to make the whole bond structure part of a safe asset system. And I think that's a kind of pretty transformative moment.
Sorry, and I just want to just jump in here because I assume that everybody is familiar with exactly what we're talking about here, just because it's been such crazy news over the past week.
Yeah.
But in case anyone doesn't know exactly what we're talking about here, Silicon Valley Bank and Signature Bank, and to a lesser extent, Silvergate, which voluntarily liquidated. So that's a different story. But two other banks failed. These are the first bank failures since 2020. And these bank failures have been backstopped by a joint statement from the FDIC, the Treasury, and the Federal Reserve, essentially committing to securing all of these deposits that were going to be in trouble because of two bank runs. Now, these bank runs occurred because of a mismatch in assets, I think is what has been suggested. We're talking about a rate hike from the Fed to the extent that some of these safe bonds and treasuries that Silicon Valley Bank held were no longer valuable or worthwhile. And then they also, from what I've heard, had some mortgage-backed securities that they had to hold on to for a long time that were essentially worthless because they had to hold them for 10 years. The concern right now, and feel free to hop in here, Rohan, but the concern seems to be that there is a moral hazard now that some of these people are essentially getting promised all of this money. They're getting promised that their billions of dollars is secured and insured, even though some people, I think the last bank that failed before this was in Kansas, some small state bank, they didn't have the kind of insurance that these people were offered. Perhaps their bank was sold, like you're suggesting. Perhaps the depositors were sold and they were all made whole. But they weren't given the same protections that was offered for these two banks right now. How do you address that moral hazard?
I mean, so first of all, I think you could describe, I saw a colleague, I think it was maybe Morgan Ricks or someone describe it. Basically, you had three tiers, right? The big banks were always going to get bailed out. The small banks were going to get sort of left to be eaten. And then these regional banks, these sort of mid-sized banks, because Silicon Valley Bank, I think, is sort of $200 billion in total assets. And it was a mid-tier bank, right? 20th largest, which is still pretty large, but nowhere near as large as the top handful. And so I would say that kind of receivership structure that we had in the past, plus the kind of large-scale bailouts in crisis moments, were a kind of de facto government guarantee, but they worked in different ways, right? You have a kind of ex-post bailout emergency facilities at the Fed on one hand, you have the receivership on the other, and then what we had here was a crash that happened sort of so quickly that the government wanted to get in very early. They wanted to get nip it in the bud before it could spread, or for other depositors, because to your earlier point, my understanding is that part of the reason that they were holding a lot of those bonds and mortgage-backed securities to an extent is that they were allowed to treat them for regulatory purposes as high-quality liquid assets. So if you're holding reserves earning 2% versus bonds earning 4%, why would you put your money in reserves if the regulatory treatment says they're the same? Well, you got to manage liquidity. Okay, well, do we really think we're going to have a run on the bank? Probably not. There you are. That's a sort of simple analysis. Now, it shouldn't have happened, especially when interest rates start going up. You should have known that your bond's going to go down. But the other question should be asked there is, what the hell are the regulators doing, allowing you to treat it that way, right? And so then there's this question about the restrictions and things that come up in 2018 and lobbying that was done by banks and things to weaken those liquidity requirements. But I think the bigger question is, what the hell do we want bonds to be? Do we want long-term treasury bonds to be liquid or not? We've been doing QE. We've been making them kind of as close to liquid money for a while. And then because of quantitative tightening, because the Fed's rolling off its balance sheet, it is trying to get away from that again. And the question to me is always why? What are we gaining from that? It's not like we had any problem raising long-term capital through those bonds. So it's not like, we're kind of worrying that we're not going to be able to sell enough bonds for any reason, not that we even need to.